Good morning and welcome to Flash Briefings by Manning Fulton. Today's topic, PPP loans, M&A considerations for buyers and sellers, is the seventh of Manning Fulton's Flash Briefings, designed to provide you with key legal insights in support of your business objectives, and to do so in a manner you can quickly digest. My name is Alan Dickinson, the Director of Client Relations here at Manning Fulton, and I'm glad you could join us this morning. It's my pleasure to introduce my colleagues, Eugene Doschert and Joe Fields, two corporate attorneys who will be leading today's session. You will have the opportunity to submit questions this morning by typing your questions into the questions pane of the webinar's control panel, and we encourage you to do so at any time during the presentation. If we are unable to address your questions during the session itself, either Mr. Doschert or Mr. Fields will contact you directly following the presentation. And with that, I turn it over to Eugene.
Good morning, everyone, and thank you for joining us on this early Wednesday morning. Our program today deals with Paycheck Protection Program loans and what to do if you are a buyer or a seller and you have a PPP loan and you're trying to understand what your options are and what's the best thing to do as you go through the acquisition process or the sale process. So I'm going to give you a little bit of background on the overall program. Joe is going to then join and give us some background on general considerations really for any M&A transaction that would be applicable in this specific case. And then we're going to go into some detail on a new procedural notice that was issued by the SBA on October the 2nd, a couple of weeks ago, that goes into some really good detail about what the options are, how that works, and what the best procedures are for you to follow if you're a seller or if you're a buyer. We are involved in some transactions right now in which this is an issue, and we have worked with PPP lenders, including one large bank, which is Bank of America, and they have developed a number of forms and have a lot of information on this program. And we'll try to share all of that with you as we go through this program this morning. A few opening basics on the program. This, of course, was passed as part of the original Coronavirus Aid, Relief, and Economic Package, Economic Security Act, or the CARES Act, earlier this year. It was originally targeted for small businesses, which was defined as businesses with less than 500 employees. But it turned out there were a number of definitions of small business in the SBA Act, and so they expanded it to allow pretty much any business. So there are a number of quite large businesses that do have PPP loans. The initial applications were accepted beginning around April the 8th, and within a couple of weeks, the initial $350 billion had already been spent. It was then expanded. An additional $310 billion was added to the program, and not all of that was utilized. In North Carolina, approximately 130,000 businesses got PPP loans, and across the country, there are nearly 5.2 million loans. So as of the first week of October, about 96,000 applications for forgiveness had been forwarded to the SBA for review by the PPP lenders. If you do the math, that's about 0.2%. There's a lot of hope that Congress will act and do a blanket forgiveness, since many, probably 75 or 80% of these loans are pretty small. But of course, that's a political matter that no one knows how it will turn out. With that, I'm going to turn it over to Joe and let him talk about some general considerations.
Thank you, Eugene, and thank you everybody for joining us. I just want to discuss some general M&A considerations for, if there's a PPP loan outstanding or involved in a transaction. It's important for buyers and sellers to start early. This is in the due diligence process. So the buyer should review the seller's PPP loan application and any supporting documentation and status, and that's to assess any risk associated with the loan. And this is particularly true in a stock or merger, or stock sale or merger. PPP borrowers are required to make representations in the loan application, and there can be lingering liability. So you just want to make sure you review the loan documents, and then also review the accuracy of the statements, the borrowers in the initial application, and then ensure document retention. There's a possibility of a future audit, and you want to make sure that you have all the documents in case there is that audit, but also it is a requirement of the borrower. And then when you're reviewing the documents, also, determine whose consent is required. So a lot of PPP lender forms that we're seeing, have consent requirements, and if you don't get the necessary consent, it could trigger, some default remedies for the lender. And of course, always review the SBA loan servicing guidelines. We're going to talk a little bit more about what was just released a couple weeks ago, but always stay on top of that. Make sure we're following those guidelines. And then, in M&A transactions, look at the structure of the transaction. So typically, an asset sale would, reduce the liabilities, and as opposed to a merger or a stock transaction where you may be taking on some of those liabilities. For seller issues in particular, we've seen that sometimes merger entities or merged entities may not qualify for the PPP loan anymore because due to their size. You got to be aware of that. Consider having the buyer comply with all the PPP loan terms, including the provisions related to any distributions or change of ownership. And the buyer should allow the seller to apply for the forgiveness and assist in the process whenever possible. And for buyers, buyers want to be involved, obviously, and have ultimate say over any PPP loan audits, and that's just to make sure there's no lingering liability. Buyers can include in the purchase agreement or definitive agreement any covenants that require the seller to fully participate in any audit. And buyer should ask for access to any records, seller's books, and just to review in the event of an audit. And then also think about identification provisions, and that is to protect the buyer and have the seller compensate them if they ever become liable. And with that, I'll pass it on to Eugene to discuss the recent guidance from the SBA.
Gotta get my volume back on here. Thank you, Joe. For M&A practitioners, one of the great things that happened on October 2nd of this year was that the SBA issued a 5-page, what they call procedural notice, that addressed how we deal with buyers and sellers that have PPP loans. The notice was extremely detailed and set out a list of rules and procedures that need to be followed regardless of whether you're a buyer or a seller in one of these transactions. Originally, and one thing I would point out to everyone is there are loans, PPP loan rules from the SBA, but you also have PPP loan documents from your lender. And so it's important to review the provisions in those documents as well for any triggers that would cover possible sales of assets or stock or partial ownership of the entity. So originally, the SBA rules provided that any transfer of ownership constituted a notice matter, and you were required to give notice to the SBA and to your lender. The procedural notice now, in a big help to us, indicated that a transfer of less than 20% of common stock or of the ownership of another entity, such as a LLC, would not be deemed to be a change of ownership that must be addressed and would not require SBA approval. So for example, if you have a small physician practice, if you have a small business, a family business, and you have a shareholder retire or get bought out and that shareholder is less than 20%, then that does not trigger notification requirements any longer under the SBA rules. In addition, if there is a sale of assets and the sale is less than 50% of the assets, that again is also not considered a change of ownership requiring notification. If there is a merger, or if there's a sale of more than 20% of the stock or equity, or if there's a sale of more than 50% of the assets, then that is considered to be change of ownership. Regardless of whether there's a change of ownership, the PPP borrower still remains responsible for all of the obligations under the loan. The PPP borrower is responsible for all certifications that were made in the process of originally obtaining the loan. And as many of you know, there was an original requirement that the borrower had to certify to the economic necessity for the loan. And that requirement remains regardless of whether there is a change of ownership. The borrower is required to maintain compliance with all loan requirements of the SBA and of the PPP lender, and also for continuing to prepare any forms and documentations, and also to retain supporting documentation in the event that the loan is later audited. So we're going to talk a little bit now about some of the rule changes for change of ownership transactions. Procedurally, prior to the closing, the borrower should notify the PPP lender in writing of the contemplated transaction. I recommend that you do this as early as possible. Once you have a reasonable, feel there's a reasonable likelihood that the transaction will be consummated. So that would be sometime between when there's a letter of intent or a term sheet agreed and when the definitive agreement is agreed to. Most lenders have forms now, and they will send a form that will ask for basic information. It's essentially what's your loan number, what's the amount of the loan, what's the name of the buyer, what's the name of the seller. They will also ask at some point what the name of the buyer is, and they will ask for documentation concerning the terms of the transaction. That does need to be submitted prior to the closing, but it does not have to be submitted as part of this initial notification to your PPP lender. The PPP lender, the other item that you must do is to follow through with the loan forgiveness. PPP lender has 60 days to review loan forgiveness, and then once it transmits it to the SBA has a period of 90 days. I'm going to turn it back over to Joe now to talk about some of the escrow and other options that are available when you start this process.
Thank you, Eugene. So what are the options when a transaction is planned and the PPP loan is outstanding? So according to the guidance from the SBA, there are no transfer restrictions if the PPP loan has been repaid in full, of course, or if the PPP loan forgiveness process has been completed and the loan is fully forgiven or is partially forgiven, and the borrower has paid the outstanding balance. It's important to note that this does not eliminate the SBA's right to challenge any representations made in the loan documents, so keep that in mind. But obviously, this is highly unlikely. Now, if the PPP loan is not satisfied, then SBA approval is not required in the sale of the stock or ownership is if the sale of the stock for ownership is less than 50%, or if the PPP loan or borrower completes an application for forgiveness, submits that to the PPP lender, and then with any required documentations, and then they establish an interest-bearing escrow account, and that has to be controlled by the lender, and it's funded with the outstanding balance of the PPP loan. And then after you go through the process and the forgiveness process is completed, then the balance must be that is not forgiven must be repaid. Also, in a sale of assets, a borrower may sell 50% or more of the assets without SBA approval. If the PPP borrower completes an application, very similar to the previous one, completes the application for forgiveness, submits it to the lender with any required documentation, and then establishes that interest-bearing escrow account, and that's with the lender, or the lender has control of that. And in these cases, the lender can approve the transaction, and the SBA is not required to approve it. Now, SBA approval is required in all other cases. That's basically any stock sale or 50% or more of the stock, or a merger. And with that, the PPP lender must submit a request to the SBA Loan Servicing Center, and it must include a number of items. That's the reason why the note can't be repaid, details on the actual transaction, and that would include some transaction documents, so like the LOI or maybe a definitive agreement, a copy of the note, and then disclosures of the borrower, and then a list of all the owners of 20% of the purchasing entity. And with that, Eugene will discuss a little bit about the escrow agreement requirements.
Thank you, Joe. If you elect to fund an escrow, escrow would need to be in the amount of the SBA loan plus the interest. Interestingly, the escrow account does not have to be with the PPP lender. The procedural notice is pretty clear about this, but it does say that the PP lender must control the escrow. Some PP lenders, and the reason for this, I think, is because some PPP lenders are not banks and don't have the ability to set up an account. So if you have, you can set up an account at a different bank to hold the funds, and it'll be a three-way escrow between the PPP lender, the account holder, and the borrower. Basically, in these situations, there are only a couple of options. One, the loan gets paid off. One, the loan gets forgiven. Or three, the loan gets partially forgiven and there's a balance due. And so control really means that disbursement will not be made until the PPP lender agrees that the balance will be paid to pay off the loan, or acknowledges complete forgiveness, or acknowledges complete repayment. So the escrow agreement is not particularly a complicated document. In my experience, banks that do escrow accounts have forms, and those forms can be modified. Bank of America actually does not want to be the escrow agent for a lot of these small loans, but they are willing to have the account at their bank, and they're also willing to not have the account at their bank. There's an interesting question, I think, about whether a law firm trust account could serve as sort of the escrow. That brings in a lot of unrelated questions about law firm trust accounts and how that would be handled. One of the requirements is that the funds held in this escrow account have got to be separately accounted for and must be interest bearing. So for a trust account that has funds for multiple clients, that would not qualify. Many attorneys here obviously participate in the IOLTA program, and although the accounts are interest bearing, the all the interest goes to the bar program. If you've ever done an escrow with this, you know there's a bank set up. So one of the holders, which in this case would be the PPP borrowers, any interest earned would be reported on a 1099 to the PPP borrower if it met the dollar limits. Some other final things just to consider in this. If you're on the buy side of one of these transactions, and you have either a merger or 100% stock acquisition, the buyer becomes also fully responsible for the PPP loan and all the representations that have been made by the borrower. If the buyer then uses loan proceeds for unauthorized purposes, the SBA will have recourse against the buyer. If the buyer itself also has its own PPP loan, then those loans must be segregated and separately accounted for, and any funds must be separately tracked. And of course, documentation must be maintained to show that these loans have been completely segregated, accounted for, and tracked. Lastly, if you're able to close your transaction, then you must, within 5 days after closing, provide information to the PPP lender. That information is the identity of the new owners, the ownership percentages, the tax ID numbers for all owners that have more than 20% of the stock or equity of the business, and the location and the amount of funds in the escrow account if an escrow account was used. I hope that this has been a helpful and useful summary of what I think is a great procedural notice that was issued by the SBA that helps us in the M&A field. If there are questions, we'll be happy to address questions. And we thank you for your attendance.
Thank you.